Hello viewers, welcome to my channel. I'm Hasham. Now I'm going to start a new subject, financial management for BBA. So in this subject, totally 5 units we have. So in this video, this is the first video on financial management for BBA. In this video, complete theory, I'm going to explain first of all the structure of the subject for BBA. So 5 units are there. The first unit, nature of financial management. In this unit number 1, we have completely theory regarding what is the meaning, definition of financial management. What is the role of financial management in the overall management system? What is the scope of financial management? What is the relationship of financial management with other areas of management? What are the objectives of financial management? What are the approaches to the study of financial management? All these things are there in unit number 1. In examination, you may get a theory question on this unit number 1. So before studying further, every student must be clear regarding the introduction of the subject. So watch this video carefully till the end so that confidently you can write the theory question in examination. Then unit number 2. Concept of time value of money. This is very important concept in financial management. That means the value of money will not remain same. Over a period of time, the value of money will change from time to time. That is calculating the discounted value and present value. So in this second unit, we are going to solve the problems on capital budgeting, NPV and IRR. Then unit number 3, sources of long-term finance. There are 2 types of finance, short-term finance and long-term finance. So what are the different sources of long-term finance like equity shares, preference shares, debentures, bank loan? So every company, every business, they will make a combination of different forms of long-term finance. So in this unit 3, we are going to study about the capital structure, cost of capital and dividend decisions. Then working capital management, 4th unit. In this 4th unit, cash management, how to prepare the cash budget. So remember, we have the practical problems in unit number 2, 3, 4 and 5. First unit is entirely theoretical. So in examination, you may get one theory, one problem or both problems from unit 2 to unit 5, right? The last unit, receivables management. That means the credit policy of the business, how to manage the credit customers, how to manage the receivables and inventory management, EOQ, ABC analysis and different levels. All these inventory management we are going to study in receivables management. Last, unit number 5. So this is the complete structure of the subject financial management for BBA. Now I am going to start the first unit, that is nature of financial management. So first of all, we'll learn what is the meaning of the term financial management. Financial management is a subject which is concerned in managing of funds or managing of finance. Just like an individual, a person will earn the income and that income will be spent on paying the different bills, liabilities or purchasing the assets or for our personal use. So how an individual will manage his own funds? He is getting the income and he is meeting the expenses. Same logic will be applied to a business organization. A business organization will have its own sources of money and also it has obligations to pay the money. So managing the finance is called financial management. So simple words we can say, from where to procure the funds and where to invest the funds or utilize the funds, so that the business should not confront with a problem of cash shortage or finance shortage. So financial management is concerned with optimal procurement and effective utilization of funds. Best simple meaning is how to optimally procure the funds and how to effectively utilize the funds. Remember, there are different resources for running a business. Like we need building, we need material, we need machinery, we need human resource, we need finance. But finance is very important because without finance we cannot procure the material, we cannot hire the employees, we cannot purchase the machinery. So all these things require finance. So financial management is concerned with procurement of funds. Procurement means raising. From where to raise the funds? The funds can be raised from different sources. So business organization has to find out from where we have to procure and how to effectively utilize the funds. That it is a process of acquiring and utilizing funds of a business. Different definitions, meanings are given. So finding out from where to procure and how to effectively utilize. The financial management is concerned with efficient use of important economic resource, that is capital funds. Without capital, no business organization can survive. So managing these funds is financial management. Now, from the above definitions, different authors have given different definitions to the term financial management. From all these definitions, we come to the conclusion regarding financial management. What is the conclusion? It concludes that financial management is defined as that part of management which is concerned with mainly raising of funds. Management has different functions like production function, marketing function or purchasing function, human resource function. From the different departments, different functions, finance is the most important part of business management, with mainly raising of funds in the most economic and suitable manner. That means the business has to raise the funds in the most economic manner. Economic manner means lowest cost. The funds should be raised at the lowest cost and suitable manner, using these funds as profitably as possible. Not only raising the funds, but also effectively utilizing the funds. The funds should not go waste. Idle funds will not generate any income, whereas idle funds will incur cost. So remember this. Now from all these meaning definitions, we come to the conclusion that it is that part of management which is concerned with effectively utilization of finance, from where to procure the funds and how to effectively utilize the funds. Now, relationship of financial management with other areas of management. There is a close relationship between financial management and other areas of management. All the departments are not independent. Every department depends on one another. Similarly, financial management versus marketing. The marketing management is concerned with publicity, creating the demand or distribution of goods and services produced. So for promoting the marketing manager requires funds. So finance manager has to provide the funds for marketing. So without funds, the marketing function cannot be done effectively. So funds are required in marketing management. So there is a relationship. There should be coordination between finance manager and the marketing manager. Similarly, production. The production manager wants to replace the old machine with a new machine in order to reduce the cost of production. But replacing old machine with a new machine requires funds. Again, there is a need for coordination between finance manager and production manager, because there are financial implications of replacing old machine with a new machine. Then personal department is concerned with human resource department. So for acquiring human resources, funds are required, because we have to make the payment regarding remuneration, salaries or other benefits according to the requirement of the job. Again, financial implications are there in hiring, in recruiting the human resource. The personal department has a relationship with financial department. And purchasing department. The purchase manager wants to avail the discount. For taking the discount, bulk purchases should be made. When we make bulk purchases, again, more finance is required. So there is a need for coordination between finance manager and the purchasing manager. So we can say that there is a direct relationship between finance manager and all the other areas of management. Now many people will argue that financial management and accounting are one and the same. No, these two are different fields of study. The objective of accounting is to record the transactions in order to prepare the financial statements, in order to evaluate the performance of the business. That is the objective of accounting. But financial management is concerned with managing the funds, raising the funds and utilizing the funds. That is the objective of financial management. So these two subjects are entirely different. Next, scope. The scope of financial management is very wide. So what are the items that will come within the scope of financial management? Now we'll study. The scope of FM covers the activities of raising funds, deployment of those funds. Raising funds means procuring the funds and application of those funds and distributing the returns to the various stakeholders. That means three things are covered in the scope of financial management. First of all, raising the funds, deployment of funds and distributing the returns to the various stakeholders. The stakeholders are owners. Dividend has to be paid to the owners. Interest has to be paid to the bankers. Amount has to be paid to the suppliers. Taxes have to be paid to the government. So employees, the salaries and remuneration should be paid to the employees. So all these are the disbursements which are required to be made from the funds available. Scope of financial management is raising the funds, utilizing the funds and distributing the returns to different stakeholders. While doing this activity, the finance manager needs to ensure liquidity. So always finance manager has to maintain liquidity. Liquidity in the sense sufficient cash inflows should be there to meet the cash outflows. That means always the cash inflows should be little bit more than the cash outflows. Then only we can say the liquidity position is good. So it is the responsibility of the finance manager to maintain liquidity. See that the cash inflows are more than cash outflows. So the scope of financial management includes what are the items that will come within the ambit of financial management. First one, financial planning. See here, every business needs planning. Planning is the first function of management. So financial planning means, taking the decisions regarding short-term finance and long-term finance. Short-term, within the short period of time, just like 2 months, 3 months, 6 months or 1 year. Within 1 year, how much funds are required? We have to make the planning. Similarly, in the next 5, 6 years or up to 10 years, long-term planning. So all these financial planning should be done. That is within the scope of the financial management. The finance manager has to make short-term and long-term financial plans. Secondly, investment decisions. Before making investment, the finance manager has to evaluate. Just like a business has to purchase a machine or to set up a factory, purchase an equipment, purchasing a vehicle. So these are all investment decisions. So before making the investment, the finance manager has to evaluate whether it is prudent or not to purchase, to invest in this asset. These are called investment decisions. So investment decisions, again, finance manager has to play a very important role in deciding whether investment should be done or not. Next one is financing decisions. Financing decisions are concerned with raising. From where to procure the funds? So many different sources are there. A business can procure the funds either by equity shares or preference shares or debentures or bank loan or nationally or internationally. So many sources are there. And every source will have their own positive and negative points. So a business has to make a combination of all the different sources. Some part should be equity, some preference, some debentures, like that. That is called capital structure. An appropriate capital structure will reduce the cost of capital and increase the profitability. So again, financing decisions are within the scope of financial management. Next come dividend decisions. Dividend is the part of the profit which is distributed to shareholders. So every year whatever profit earned by the company, the whole profit will not be distributed. A part of the profit will be retained within the business in reserves and the other part will be distributed. So how much part should be distributed and how much part should be retained? That is called dividend decision. And dividend decision has a very important implication on the company, on the business. Finance manager has to help the management in taking dividend decisions. Appropriate dividend decision will increase the value of the business. Next comes working capital decisions. The business requires funds for two purposes, for long term and short term. Short term funds are called working capital funds. That means the funds are required for paying the suppliers, for paying the interest charges, for paying the bills like salaries, rent, electricity. For all these short term obligations, sufficient working capital should be maintained. So maintenance of working capital again comes within the scope of financial management. Implementing financial control. Without planning, we cannot be able to control. And without any control, only planning is there, we cannot be able to achieve the goals. So along with planning, we must have controlling. That means the finance manager has to see that whatever we have planned, are we achieving it or not. That means evaluating the financial performance of the business. That is also within the scope of financial management. So this discussion on scope of financial management is very important because in examination they have asked, explain the scope of financial management. So if you watch this video carefully, you can remember, you can note down the points and you can excellently write in examination. Now, very important topic is objectives of financial management. Very frequently, every now and then, a question is asked in examination, what are the objectives of financial management? Different people have given different definitions. Traditional objectives and modern objectives. So all these objectives we are going to learn and you have to write these points in examination. Financial management has multiple objectives and these can be classified as basic objectives and other objectives. For our convenience, we classify the objectives into basic objective and other objectives. The basic objectives. The primary objective or basic objective is profit maximization. Normally, it is understood that the main objective of any business is to earn profit, is to maximize the profit. When the business objective is to maximize the profit, the financial management objective is also to maximize the profit. Because financial management is concerned with managing the funds of the organization. So whatever it do, it will do for the benefit of the organization. So here the primary objective, the traditional objective of financial management is profit maximization. However, recent thinking among practitioners is that the ultimate goal of financial management is to maximize the wealth. The traditional objective is to maximize the profit. But the modern thinkers, modern practitioners, they have shifted the objective from profit maximization to wealth maximization. The modern objective is wealth maximization. Traditional objective was profit maximization. Now the basic objective of financial management are profit maximization, wealth maximization and value maximization. All the three I am going to explain and what are the positive and negative points of every objective. First one, profit maximization. So the profit maximization objective is traditional objective of business. The primary objective is to generate highest possible profit in the short term. Normally, every businessman says, my objective is to maximize the profit. So naturally, The traditional objective is to maximize, generate as much profit as possible. But arguments favoring profit maximization. So there are positive points and negative points of this profit maximization objectives. First, what are the positive points? First one, clear and measurable objective. We can measure the profit. We can calculate the profit. So the objective is more measurable, more clear. It is not ambiguous. So it is more clear. That is the first advantage of profit maximizing. Essential for survival. No business can survive without profit. Profit is just like the blood of the business. Without blood, no person can survive. Similarly, without profit, no business can survive. So profit is essential. Third, measurement of efficiency of business. By seeing the profit, we can measure how much business is efficient. If a business earns sufficient profit, the business is efficient. Like that we can say. Now, efficient allocation of utilization of resources. If we have profit maximization, we can effectively utilize all the resources like material, machinery, human resource, or all the facilities we can optimally utilize. Then contributes to economic growth. When profit maximization is there, every firm will try to maximize the profit. In this way, there will be economic growth in the country. Focuses on interest of shareholders. The profit goes to the owners. Owners are the shareholders. So our concentration is profit maximization. So automatically it will maximize the owners. These are the points in favor of profit maximization. But there are some negative points of keeping this profit maximization objective. We should not think only of profit. Apart from profit, you have to, simple example I'll give you. If you are having a business, if you focus only on maximizing the profit, ignoring the quality, ignoring the service, then what will happen? Your business will collapse. Your objective is not to earn only profit. Apart from that, you have to provide the service. You have to provide better quality goods. You have to make good relationship with the customers. All these ethical, considerations you have to consider. Then only you can survive. Otherwise, if you put profit as your profit maximization as your objective, it's a short-term objective. Now, what are arguments against profit? Profit is a very vague concept. Vague means ambiguous, because we have different meanings for the term profit. It may be gross profit, it may be net profit, it may be profit before tax. So we don't know which type of profit you want to maximize. So it's a vague concept. Next, short-term perspective. If you focus only on profit maximization, your objective is short-term. In the short term, you can survive, but there is no guarantee that your business will go in the long run, because you are concentrating only on profit, nothing else. Next, time value of money is ignored. When we consider profit maximization, we are ignoring the time value of money. We are thinking that today's money and future money both are same. That is not correct. Focused on interest of owners. Because profit goes to owners, we are focusing only on owners, ignoring the other stakeholders. Ethical considerations are ignored. That means what is good, what is bad, that is completely ignored. We are not concerned about the security of the customers, about the service of the customers, satisfaction of the customers. We are ignoring all ethical considerations and we are focusing only on profit. That is not good. These are the points against making profit maximization objective. Now, second very important objective is wealth maximization. So many people will discard the profit maximization objective. They will give the objective as wealth maximization. That means the objective of financial management should not be profit maximization, but should be wealth maximization. Whose wealth? The wealth of the owners. The owners are the shareholders. So here wealth maximization is a broader and more holistic goal of financial management. That means the scope of wealth maximization objective is very wide compared to the profit maximization. It is more holistic goal of the business, and that focus on increasing the overall value of the business to the shareholders over the long term. Profit maximization is a short-term criteria, whereas wealth maximization is a long-term criteria, maximizing the wealth of shareholders in the long run. In other words, wealth maximization means maximizing the wealth of the shareholders. And according to this objective, financial management must select those decisions which create most wealth for the owners. Whatever decisions finance manager will take, he should keep in mind that whether this decision will increase the wealth of the shareholders or not in the long run. From that perspective, decisions should be taken by the finance manager. Then again, arguments in favor and against of wealth maximization objective. Favor, consistent long-term sustainability. Remember, the profit maximization objective is a short-term theory. That means in the short term, they want to maximize the profit. But here, wealth maximization is a long-term perspective, long-term sustainability of the business. So, comparatively, wealth maximization is good because it is taking the business in the long run. Whereas profit maximization will take the business in the short run. Whereas primary focus on stakeholders, shareholders. The primary focus is on shareholders because we are maximizing the wealth of the shareholders. Ultimately, the business belongs to shareholders. Then based on cash flows. The profit maximization is based on profit criteria, whereas wealth maximization is based on the cash flow criteria. That means cash inflows and cash outflows. So this wealth maximization is much superior objective to profit maximization. Then considers time value of money. This profit maximization will ignore the time value of money, but wealth maximization will consider the time value. Considers risk. Even risky projects will also be considered if we keep profit maximization, because their ultimate aim is to maximize the profit. It will ignore the risk, but wealth maximization will consider the risk factor because it has to go in the long term. Then security to lenders. When we keep wealth maximization as an objective, then the lenders of the money and lenders of the funds and suppliers will also be secured. Then guides management in dividend policy. Wealth maximization objective, if we keep, they will help the management in taking the dividend decisions. Lastly, optimum utilization of resources. When we keep wealth maximization as an objective, we can effectively utilize all the resources. These are the positive points of keeping wealth maximization as an objective. Now, what are the negative points? Contributes to inequality. That means we are again focusing only on one stakeholder, that is shareholder. We are ignoring the other stakeholders like bankers, suppliers, government, consumers, employees. We are ignoring. So there is inequality. High risk. That means sometimes the risk taken will be more in case of this one. Social responsibility. We are considering the social factors also in case of wealth maximization. In that case, what will happen? The profitability will come down. Then ethical considerations are also considered that will increase the cost. Market volatility. Market will not be same. It will be dynamic. It will be ever changing. In that case, it will be difficult to keep wealth maximization objective. Lastly, neglect interest of other stakeholders. We are not considering the other stakeholders' interest. So these are the points against keeping the wealth maximization objective. So in the coming video, next video, I'll explain you what are the other objectives apart from profit maximization, wealth maximization, and then value maximization. Other objectives that I'll explain in the coming video. So if you want the perfect knowledge on the subject of financial management for BBA, remember, theory is very important. Only 2 videos I'm making for theory, then we'll go for practical problems. So if you are satisfied, give a like to the video. Share my channel among your friends, groups so that more students can watch the